and welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable, real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Hey, everybody. Today, we are talking with a former pro athlete, a former scientist, and full-time real estate investor. Man, just touching in on some of the things that I've done and that I do too. So I'm excited to talk to him about this. His initial work was focused on rehabs, acquiring severely distressed properties. Oh boy, those two words put together give me goosebumps, and I can smell it right now. He transforms them into beautiful homes. Relying on his strong work ethic and intimate knowledge, he now focuses on apartment buildings. And check this out, helping others create wealth without Wall Street. Everybody, please welcome Noel Parnell. Hey, man, how's it going today?
I'm doing great. I'm excited to be here. I'm ready to go kind of talk shop and tell you guys what I'm doing on and working on right now.
Yeah, so it's really cool. So just let the listeners know out there today, it's going to be probably more real estate based today. And I tell you what, Noel came in a fury on this Zoom call today, just excitement and glowing. So that's happy, man. I love to see that. Welcome, man. Welcome.
Thank you.
So let's hit this first. Former pro athlete. Tell me a little bit about that.
Yes. So I was a former track and field athlete. So I did try out for the 2008 games. I was stationed, not like as a military, but there's United States has Olympic training camps all over. There's one in Colorado where a lot of the swimmers and wrestlers go, Florida. You have Lake Placid in New York, where a lot of the winter sports, and then you have San Diego and Chula Vista. And so I was out there, training, and I was actually based in North Carolina training as well with Marion Jones. I was in Marion Jones training camp, and just years and under 10 seconds, it was gone. Yeah. And I did not make an Olympic team. But something better happened, I got the opportunity to still go to the Beijing Games and guide run for a Paralympian who is legally blind. He is fast as you know what, and that's why they needed an athlete to be able to run with him because I'm going to be his mirror image. So we're tethered by the hand by really like a little string, and I'm like he's right-handed, so I have to run left-handed. If that makes sense for all my runners out there, if you have a starting mark, everybody has a foot that they put up naturally first. Yeah. I had to adjust to doing my opposite leg first, and I was his mirror image, so we can have the mechanics. And what that taught me was that was my first lesson and love of helping others, because at that point it was no longer about me; it was about me helping someone else live out their dream, and that was so fulfilling for me to actually guide him through that whole process. So I'm always really appreciative of that moment, and from there. I got kind of, I don't want to say coerced, but my stepmom and father were like, what are you going to do now? You didn't make it. The game's over. What are you going to do now? And this is right after the White House visit. George W. Bush is funny as all heck. I would hang with him. That's one of the things I got from the White House visit, is that he was constantly cracking jokes. And I was like, you know what? I would hang with him. Yeah. But they were like, what are you going to do? And I was like, I was 26 years old. And they were acting like it was the end of everything. I could have went for a number 2012. And what I learned from that is that don't let someone else's fear be, impair your goals. I took on their fears and grasped it. And I was like, oh yeah, I have to do this. My father was worked at Merck. My stepmother was a VP at Allergan at that time in Delaware. No, AstraZeneca in Delaware. And so that's what they wanted me to do. I come from my mom was working at UPenn in the lab. So I kind of come within that realm in industry. And they were like, what are you going to do? So I went to work at GSK. Lo and behold, about 6 months later, you get what I call a graceful firing. And, when they lay you off, I always thought it's a graceful firing. And it's often that I would actually rather be fired than the graceful, like the laid off, because it's like a Band-Aid. I can get over with it and done and move on. But when you have that date that they're giving you, now it's all that anxiety. Like, what if I don't find something? I have to look here. I have to complete my work here. Most recently I had folks at Adaptimmune that's on the Naval Yard in Philadelphia, and they were telling me this past October, they were told they were going to be laid off this February. They didn't know who was going to be laid off. They just knew that layoffs were coming.
Right.
They're telling them also that if they leave beforehand, you can't receive your severance. So do you see the bottleneck?
That's crazy.
I think let's understand what they're finding a biological license. So for a drug. And so they were like, no, we need this to go through. But if you leave, you're going to lose your severance. And I'm just like, that was the same kind of stuff I was mad at when I first got laid off, that, some people like bottleneck it, because I didn't hate my job. I still love science. I'm still a geek. I still, I'm still like wavering. Like, do I want to go back to go to pharmacy school? These are things like goals. I'm more goal oriented now. And I'm like, do I want to go to pharmacy school? Do I want to do that? Do I want to kind of do a small startup, and try to raise capital for a startup for biomarkers? Mm-hmm. But I hated that they put people in a really a compromising position. Like, you can't go look right now. You lose your severance. You don't know you're doing a great job. You're performing if you're going to have your position come February. Mm-hmm. And I was just like, that was the exact reason why I went into real estate and why I love multifamily real estate. It's just the forced appreciation. I love that it's already cash flowing. I love that my return. I use the wealth without Wall Street loosely because I still do invest in the stock market. It's low right now. I would advise anybody, I'm not a financial advisor, but use your common sense and dump it in there. Dump it in there, dump it in real estate. I would never keep any of my money in the bank if I didn't have to show it to be liquid to do loans. To be honest, I have to show a certain amount, and then also, the climate is changing. A lot of banks want you to keep sometimes 10% of the loan value in cash in their bank. So when you're doing these new commercial refis, they're changing the rules of what you have. So I have to leave that money. Sometimes
you can negotiate some more attractive terms if you put something in there with them too.
Yeah. But, cool. But still, if it's earning 3% or 4% and inflation is at 8-9%, my money's come on.
Cash is trash. We call him Uncle G, Grant Cardone. Cash is trash, man.
I look at that and I'm big into metrics, and I'm like, Apple did $10 billion within like 3 or 4 weeks when they opened up their savings account. That's 4%, and I'm like, wow. They're probably benefiting, but everybody else, you're losing.
Right. We got a little bit of a lag on the signal here, so I don't know if you can change that. So I apologize to the listeners out there if you could pop that in. I'm like filling the words in. There's a little split. I'm catching it, so hopefully everybody else can. So into this real estate world, you didn't go right into apartments, right? You kind of used single family residential as a stepping stone.
Yeah. And I wish I would have known, I started at a time where real estate is a lot more sexier now and things are more accessible, whether it's social media or LinkedIn. But if I would have known what I know now, I would have either, invested passively with someone else for the returns and not the headache of, landlording, or I would have I had enough colleagues that we could have, started one up together, and it's predominantly my investor base or, former colleagues or former teammates from college. That's my investor base, and that's what we do. But I would have, I would have long went without, single family homes, Yeah. And even look at COVID. When COVID hit, the biggest hit I had were on my residential. Yeah. My apartment buildings weathered the storm. My residential units, they took a beating.
Interesting. Do you think that's market driven because of, when you say COVID, there was definitely some federal stuff coming down the rails, but each municipality kind of has their own kind of
Yeah. Yes and no, because depending on where you are, that's also why I kind of invest in red states now. So that's how I got into Texas and Kentucky, just from, being in Philadelphia and having the kind of the tenant friendly. But also, I think it is, there were people in the apartment buildings that, weren't paying because they were getting money, they weren't paying. But overall, the percentage wise, I had more economic vacancy or occupancy than I had in my residential. And what I mean for that for the listeners is that when you have in a building, you'll have physical occupancy and then you have economic occupancy. The physical is like who's actually living in there, but they're not paying nothing. The economic means who's living in there and they're actually paying. So you always want to look at your metric for the economic occupancy, and it was much higher in the apartment buildings.
Very, very interesting. And this, the COVID thing in itself is just a crazy thing.
Unpredicted.
Our portfolios, we did very well considering like the chaos in the world. And man, it's like we could have a whole nother conversation on professional tenants. But before we get into that piece, you mentioned red state and blue state. And the way that I was taught to look at this, Noel, is outside in approach. And so when I'm talking with people like, where do you invest and why? So it's like I'm looking at the total United States, because these days I can invest anywhere. Doesn't mean I should, but I can. And I go from that outside, holding my hands up out there for the listeners, and I've got the United States inside of my hands. Everything inside of here, I'm going to start breaking this down really easy. I'm going to find the landlord-friendly states. These states that have short eviction timelines and that care for me as an investor. I was just sharing this with somebody the other day, Noel, is like my first house I bought in 2007, right before the dinger. And I remember I had none of the right people around me. Man, I was making all kinds of mistakes. I was managing everything by myself. I was just going to buy this and sell it. But I didn't. I couldn't sell it. The market tanked. The whole school system, Noel, in this little town closed. Now I own a house in a town where there's no school system. They got to get bussed out to different areas. So this is going great, right? Anyway, the tenants that I was putting in place, they say, okay, I'll just rent it out. The tenants that I was putting in place, I did not have a screening process. I did not have anything. If you had a pulse, you didn't even have to have a checking account. You had a pulse and wanted to give me money for this thing. I need money, right? But man, in that process, I wound up in court a couple times because the tenants didn't pay. And I will never forget that feeling of how I was treated as a landowner, as an investor. I was a bad guy.
You're doing your half. You're providing them.
Man.
Dude, oh man, I can get on that because I'm like, I have to negotiate a new term because in Philadelphia, they want you to renegotiate the lease. I'm like, well, they broke the lease. They broke an agreement. Why are we negotiating another agreement? I'm providing everything I said I'm going to give you. And now I have to negotiate because you're not going to pay me?
Yeah. Noel, you're paying your mortgage no matter what. So you doing exactly what you said you're going to do.
Comes out automatic. And I always tell people, I doggy paddled a little bit. And the apartment saved me because of my portfolio. But my during the COVID, automatically, between the first and the third, all my mortgages are auto drafted.
Yep.
They're done. They're gone. I actually, from COVID, I learned, a different situation now of how I set up my loan payments. I always tell people now, or the banks, that I want them on the 15th.
Yeah, because I want to collect that rent first.
Collect the rent first. And so I always tell them like, hey, I want it on the 15th. And that's, so I learned to express that to them like, hey, I want it placed on the 15th to be there. But you're absolutely right. When I'm looking for new properties, because now I live in Philadelphia, but I invest in Kentucky, Lubbock, Houston, and Georgia. And I actually like the Carolinas. I actually like Research Triangle Park as well. Then Raleigh area, certain areas of Raleigh. But I'm always looking at landlord rights. I'm also looking at how are they on your taxes? Are the tax assessors really going up, high or low? You can look at trends of what they're doing with the taxes because that can be very impactful for my investor returns.
Yes.
I'm also looking at population growth over the last 10 years, income growth over the last 10 years. I'm looking at house value growth over the last 10 years. I'm looking to see what employers are moving in and moving out, and most importantly, crime in schools. Because I want working families in my building. So I'm looking at, is the crime rate increase or decrease over the 10 years? And what is the school system like? Am I paying a lot of taxes for a crappy school? Then I'm like, then guess what? No. But I want my buildings aren't going to want to send their kids to that school. So I'm not going to put myself or jeopardize myself in that building. There are some other nuances. If it's like a C class, I can get to a B and the numbers make sense. But the business plan of how you're acquiring needs to make sense. And I think a lot of investors forget that, or they forget to vet your sponsor. For out those, the sponsor is your general partner. What is the business plan? If the sponsor can't actually, really convey what the business plan is over the next, at least the first 3 years and also the initial 90 to 180 days of acquiring a property, that is an immediate red flag, because that is so important right there for your investors, because your investors are in there for the long haul, at least 3 to 5 years. Some people are going to be 5 to 7. And so if I'm explaining I don't have a good business plan, how can I expect to execute? And they should be able to share that with you on what they're going to place in, how they're going to achieve the rents, how they're going to get them organically. If I see and someone's underwriting that, hey, I have this building that's it's 150 unit or 100 unit, and rents are right now $800. We're going to take this building over, and I know these are going to go to 1,000. Oh, that's great, but how long is that going to take? Let me see where your projections are, because it's not going to go there immediately. There's going to be turnover from people that don't want the raise. Sometimes you have to change the culture of the building. So it's not going to be an immediate thing. So how are those returns set up? How are the disbursements set up? I'm looking at the PPM. If someone's saying, guess what, we're closing on this building June 9th, and we're giving disbursements to you on July, I'm like, that's a little rough right there.
What's a PPM?
Your PPM is your private placement memorandum.
Okay.
So your private placement memorandum, I'll back it up. I'm sorry. Your private placement memorandum is where you disclose everything. I need to let them know what my capital expenditures are. What am I going to be using those capital expenditures for? What are some of my payments? Am I getting an acquisition fee? What's the percentage acquisition fee? The acquisition fee should be like 2 to 3%. If someone's doing an acquisition more than that, and this is subjective, to me, I think that is a money grab, and I would be like, why? Because normally it's 2 to 3%. If someone's like 5 to 6, I'm like, that's a little too high. What is the asset management fee on there? Asset management fees are normally 1.5. What is a disposition fee? Disposition fee is kind of like the disposition fee is the fee that you're going to have on the back end when you sell the building. It's kind of giving your GPs a tip. I normally don't do a disposition fee because I shouldn't be tipped on what I said I'm going to deliver on for you. Mm-hmm. So I don't do disposition fees. I do know general partners and operators that do disposition fees. I do not. So, your private placement memorandum will tell you, the frequency of the payments. When are they going to start? Excuse me. Sorry, just some water.
Yeah.
Sorry, everybody. It's going to tell you when it's going to start and the frequency. It's going to have all your legal jargon, when K1s will be distributed. It'll talk about your cost segregation. That's a big thing for our investors, tax purposes. I recently was I'm a GP in a deal that's 156 units in Lubbock and Louisville, Kentucky. So 92 units in Lubbock and 64 units in Kentucky and Louisville. And our K1s came out one later than expected, but the tax depreciation was only about 35%. And so we had at GPs, we didn't deliver on what we said between 40 and 50. We went back behind the doors. You know what? We made the right calls on what we were going to do, and give up what we have to give up. and we're reissuing K1s so the investors can get that. It's going to be about, I think, 42% for them, but there's going to be in that range in which you deliver on. In this business as an operator, integrity should be number one on everybody's list. Delivering on what you said you're going to deliver on. Your communication, how are your newsletters? When something goes wrong, how are you communicating? When you have to have those tough conversations. We fired a property management company within 6 weeks of acquiring a property.
Wow.
Oh, you got to tell you have to reassure your investors of that you just told previously, like, this is why this is going to work so well. We have to fire them. But you have to have enough, one, integrity again, to know like you're doing what's best for your investors and say, hey, this is how we're moving forward. And that's where communication comes into play. Always kind of keeping up on the newsletters, having an investment day. Like, we like to bring our investors out to the properties, pick a day. Texas sometimes is a little too hot, so we try to pick a day, but it's always kind of hot depending on when you go. But we want to have them come out for what you're invested in. You want to know what's going on. So I think the communication part is really key, but I'm always, there's a lot of sponsors out here. I see a lot of great marketing, and I'm always wary of that because I see some returns that people are saying they're going to get. I'm seeing some folks saying, again, 8-9% cash on cash return. I traditionally see cash on cash return coming in literally between like 4 and 5, maybe. That's where it's at.
Noel, do you think that's because
it's
what's so called fluffery or something? But when you're not taking all the expenses out, like when I'm single family, so it feels a little smaller. But when we're talking about these types of returns, it's very similar. I want to see, in my own books, I stay super conservative. So I want to take out my reserves, my holdbacks. Like, I'm taking all that stuff out. I'm not counting on it because it's going to get spent. So when I see turnkey people put numbers out that work, but then you dig into them, it's like, no, that's not what I'm looking for.
It's fluff and it's marketing because it's a competitive market right now. Again, it's easily accessible right now. Funds and syndications. Normally, this was kind of stuck to family offices, and you had to know someone that knew someone that was in a family office that was investing. Apartment investing was going on forever. Yeah. It's just now that it's more broad and advertised to folks that like, oh my goodness, I can do this and not just kind of stick my money at a match for 401k. Mm-hmm. And I don't have anything against matching 401ks, but I also believe an employer is not doing that out of their best interest. I mean, they're probably lowering your salary to give you that match anyway. It's not out of their goodness of their heart. Yeah. But a match is still a match. What I would say though, in this the world we're living in right now, when I see some operators cranking out deals and they're giving a pref, which means they're giving a percent to your investors before they pay themselves. That means the deals, they only get paid when they purchase the property and when they sell it. So they have to crank out a lot of deals because they don't have any cash flow. Mm-hmm. So they're trying to sign as much deals, which is a cash grab to me. And when you have someone that's doing a cash grab, that's where it gets shaky because you're not looking into the best interest of your investors. And again, I'm not selling anything right now. We don't even have anything to go. But if I had something, I can walk people through underwriting. Like, what questions do you have with the underwriting? I freely give out underwriting software because I truly believe that when I talk to people, I want to know, like, what type of investor do you want to be? Do you want to be active or do you want to be passive? An active investor, you can pull with some of your colleagues and can do this as well. There's a group of doctors and there are two surgeons and the other ones are pediatricians in DC. That's what they're called, Excite Capital. That's what they do. And so they are, and they're active. And so it's like, I don't know how they manage that schedule because they are active surgeons. Yeah. And they partnered and they do syndications. And so, that's what they do. But you have to choose, like, what do you want to be? Do you want to go lead these deals? Do you want to underwrite? Do you want to do the due diligence? Or do you want to go ahead and just use it as an investment vehicle? And it's hit or miss. I always teach people both because, it's always about what your goal is. If you're just trying to make sure you get a good return, yes, we can make sure you get that good return.
So in my conversations with physicians, and everybody listening to the show here, it's that syndication piece is something that's reachable, attainable for them because is that passive piece. So extremely focused on their passion, their niche, and practicing medicine, developing an entrepreneurial idea in the midst of this. And the idea of real estate is something that I know a lot of the listeners know that's the way to go. And that passive piece is nice, but man, as soon as you started, we jumped into apartment buildings really quick here, and you just like your experience just went bam. I mean, there are acronyms. No, it's beautiful. There's acronyms and all kinds of stuff, and it's just I'm sure a lot of the listeners are overwhelmed on that. And then what made it even more difficult, Noel, was like, yeah, you need to know who you're investing with. So to me, I need to know these things if I'm going to invest with somebody.
Yeah.
So I guess the question is how. Say, an accredited investor, right? There's certain levels that I can hit with different kinds of syndications. Basically, that what you're doing gives you the ability to invest in certain things, right? I don't just because I've got some cash doesn't mean I know what I'm doing with that cash.
Correct. Yep.
So what is your suggestion for maybe a couple steps here? Some of the physicians that will say, hey, I know this is a direction I want to go. Maybe I've got 50, 100, 250 right now that I like this setup of a syndication where, I can find this platform and do like 18-month kind of thing. And, you're talking preferred returns and, find this group, or you mentioned GP, right? General partners, find this sponsor, this pocket where they've performed 4, 5, 6 times. And I know I'm comfortable doing my 50, 100, 250 or whatever it is in this. What's the best step for somebody that's right in the beginning of putting that money into somebody?
I would say, I guess the easiest way is to ask for a track record. When you're in this realm, signing loans, the most, I guess, advertised. You have non-recourse and non-recourse. Non-recourse is, again, anything over $1 million, but you don't have to be the personal guarantor. Then you have recourse, where you have to be the personal guarantor. When you have the most popular non-recourse are backed by the government, Fannie and Freddie, you can only do a 1-to-1 ratio. So if you're seeing them saying they have, this many properties, or this building right here, and this building is worth 11 million, they should be able to show you they have 11 million in net worth, because the bank will not allow you to sign on a loan by yourself if you don't have $11 million. I can only sign up to $4 million because that's my net worth. Mm-hmm. I will partner with other GPs so we can combine a net worth. And then also sometimes you want to combine experience. Sometimes I've located an area where I'm looking like, man, these metrics look really good, and I'm doing, my background knowledge as well. I'm like, all right, but who's the person there that's kind of really familiar with those property management companies in there? What's their CV looking like? And just like anything, you have a CV for any profession. You should have a
CV.
It's kind of this your resume. That's okay. All. That's your resume. So you should have a real estate resume of the loans that you signed on. What deals have you done? What I've always done is that I always give people, if they're working with me, I'll give them investors. These are investors. You can talk to my current investors and ask them how they're doing. And they can show you the PPM, like, hey, guess what? They're really in it. There's not any fluff. This is who they truly are. Or these are one of my lenders before, and they seen like, guess what? This is my track record that I performed well with them. And so I'm very big on validity, because I feel like, again, real estate is so sexy right now, especially multifamily. And there's a lot of people getting over on folks. There was the situation that happened in Houston with Arbor Realty, if anyone doesn't know, and they foreclosed on a bunch of properties from a gentleman in Houston, and a lot of people lost their money. there were red flags that he wasn't operating the building, correctly, and so, there's always a risk to real estate, but then there's a way to, risk mitigate. And we have to make sure that we're doing that, particularly with the sponsors and how we're vetting your general, I always call them GPs, but you're your sponsors. And I want to give just kind of, because I want people to understand. So a GP is really called it's the general partner. It's really the lead person in the real estate. They're going to do all the daily activities. They're going to be doing the property operations. They're going to manage the day-to-day operations. You have what they call the key principal. A key principal or KP is someone that you would bring on if you didn't have enough net worth to sign on a deal. So let's say I have a $7 million deal on the hook. I know I can't sign for $7 million. I can reach out to a gentleman or woman that's saying, hey, there are people that advertise themselves as KPs, and normally they'll take between 10 and 25% of the deal to bring their name to the deal and their net worth. Mm-hmm. And you can go ahead and get the deal done that way. And all they're doing is sometimes they're just their name, sometimes they're just a guarantor. That's all a KP or key principal is. And then you have limited partners. Limited partners are also known as investors or passive investors. They invest their funds into the deal and provide majority of the capital needed to purchase a property. And so that's why the splits for the property are they're always in favor of the limited partner because they're bringing, the split. So normally the equity splits are normally 80-20 or 75-25. And that means any profits from the asset are split according to the ownership percentage of the GPs and LPs. So that same percentage is used for all returns that the syndication.
And you said 80-20 and 75-25?
Yeah, sometimes it's 80-20 and 75-25. And that's in favor of the LP who's the investor.
Okay.
And
so how is the risk mitigated then for Noel for the LPs then? Because what I like about ownership of real estate is that deed. Like nobody can steal that deed from me, short of stealing my identity, obviously. But so where does that come in then for the LPs? Like you said, that thing with Arbor Realty where they lost. How does that happen?
That's the risk where you're investing your money and they weren't communicating about the returns and the issues that they were having with the buildings. And so what happened, I believe what happened with them is that once interest rates rose up, they couldn't cover their DSCR. For those out there, that's debt service coverage ratio. And they fell behind. And that's is
an adjustable rate note that they had signed?
Right. A lot of people did adjustable rates, and a lot of people did bridge loans, which are, maturing, and they might have been on the bridge loan for 3%. But now that bridge loan is over, you have to get regular financing. And that financing you're getting, I'm seeing rates now at 5.4 to 5.8. That's where I'm getting quoted rates right now. If you were already used to, and you were cash flowing at 3%, that a point will kill you.
Yeah.
So You just imagine going to 5.4. It tears the deal apart. And that's what you're seeing a lot of because people aren't locked into long-term debt, right now.
So what is, I completely understand because we're looking at 5/1 ARMs, but I'm also, but this is a smaller scale on single family though. And we're looking at caps and margins with where we're trajecting the next 2 years. One thing I think is fascinating, Noel, is watching or hearing where note buyers are, debt buyers are. What they're not buying is probably what I want to put my money to borrow as, because they know they're not going to make their money. That means it's good for the consumer, for me. When you say bridge loan, what do you mean exactly by that? Tell me a little bit about the bridge loan.
So a bridge loan is just it's a short-term debt, and normally it's only 2 years, and it's only used to kind of get you across the finish line until you can acquire other debt.
So it's like a handicapped arm. It's like a shortened arm kind of thing, with no extension. Does a bridge just stops, huh?
Yeah, it depends on your lender. Sometimes you can get some extensions, but not all the time.
Right. Interesting. So we've got general partner, we've got key principal, we've got limited partner, all of this stuff. And I heard that the question I asked was, how do we know? Like, I don't have time to go research a whole bunch of stuff. This is the direction I want to go. And you said, research the general partner, right? Show me proof, show me results.
Who's the jockey? You have to know who your jockey is.
Who's the jockey? Interesting.
Yeah, I like to call that, because he's the one running the show. Who's your jockey running this program? So, what evidence are they giving you that this can be? Because this is it's not a short-term thing. This is a relationship. This is going to be for the next 3 to 5 years. So how are they communicating with you? Are they trying to rush you into signing something or sending your money over immediately? What is the offering that you have? Offerings can be 506B or 506C. And so, for those right there, that's accredited and non-accredited investor. And so you have the accredited investor. Your accredited investor is an individual, has an income exceeding $200,000. And if they're married, they have a income exceeding $300,000, and they have a net worth that exceeds $1 million.
Interesting.
If you're not accredited investor, you're just anyone that does not meet the requirements.
So being an accredited investor by the law, I don't know if this is FTC or where these particularly come from, but that's saying that you know what you're doing. So you get to go into the deep end of the pool because you have this much money, not because you made it investing. Yeah.
So SEC, that's why they kind of separate them.
Yep.
Yeah. They give different rules for that. So they feel that there's also a sophisticated investor term as well that they have, but they give rules that saying, guess what? This accredited investor has more knowledge, and technically they're kind of saying indirectly they're more savvy. So I don't want to say they don't need to be protected as much, but people can solicit to an accredited investor. So you have a syndication offering. It's going to be called either a 506C or a 506B. A 506C offering is open to accredited investors only. And you can tell when you have a 506C offering if you're seeing public solicitations and advertisement. So if you just see regular thing like, hey, invest in this, these are returns, that's only going to be for I'm sure if you look at the fine print, because they have to list it, that this is only for 506C offerings, which are accredited investors. If you have 506B, the 506B, the law strictly lets you know that you're not allowed to perform public solicitation, advertisement, or social media postings. You have to actually have a pre-existing relationship with that person to actually participate into that deal itself.
And then the GPs, is there any requirement that would say that you have to be 506B or 506C? Is it the deal? Is it the experience of the GP?
Yeah, we have to label that first. So what a lot of people do is that some people will do 506B offerings, because then with 506B, you can raise money unlimited from accredited investors, but you can have only a max of 35 non-accredited investors. My personal thing is I like 506C. I like accredited investors because I don't want 50 people in my deal, to be honest. Mm-hmm. That's why I don't do crowdfunding. I don't want $500 or $1,000 here. It's just, I don't want to come off signing sounding like, oh, that's not a lot of money, but it's not worth the time to manage all those individuals, because you're managing those relationships.
Yeah.
I would rather have maybe, 15 to 20 people, accredited investors. And then you can actually, it's easier to communicate. It's easier for the newsletters. Sometimes their careers are more white collar because you have to make sure you have to verify them. Someone can't just say, "Hey, I'm an accredited investor." You have to have a letter from your CPA, and some people actually ask for like tax returns. So you have to earn those figures I was talking about, over 200,000 or jointly 300,000 per year. I think it's like you have to have it like 2 or 3 years in a row. Wow. I think it's at least 2 years in a row you had to earn that. But I think it may be 3, but it's 2 to 3 years. So you have to actually present that to your operator, who's your GP, right. And that needs to get placed. When the lawyers and everything are doing everything that they're doing, it needs to be placed in there.
So you mentioned something about software that you give out. What did you mean by that?
Oh, so I'm always big on value and abundance. So I like to teach people like how do you locate the places that we how would you want to locate if you want to do a deal yourself? Guess what? This is where you should pick an area, and these should be your metrics. We talked about red states and all those, but then also there's target acquisition criteria. My top target acquisition criteria is again location, the deal size, price per door, the year built, the class of the property, the cap rate, and the cash flow. The class of the property is really important depending on your offerings. I think it's important for both, because a lot of people have C-class buildings. I won't do D-class buildings. There's level classes of buildings, everybody. So there's D-class, which is war zone, C-class, what they like to call in the industry, multifamily crap areas or crap low-hanging fruit. It is. That's what we call it. C for crap. Yeah. And it's not really crap, but it's low-hanging fruit. You have your B-class properties, and then you have A-class properties, which have been probably newly built within the last, 3 to 4 years. And if you're having a C or D-class property, you're trying to raise it, and you're trying to raise money for this, if you're saying, guess what? I'm doing this as a 506C offering. That means accredited investors only. And this is for physicians or MDs podcast. I'm gonna say I'm going out to all doctors. They know nothing about multifamily, but I'm saying, hey, we have these great returns. Here you go. And you see the property, and you're like, oh my God, look at all this stuff. Are you going to invest in that? If you're looking at that area because it's your first site and you have no knowledge of real estate, and I'm telling you, it's going to be the offering, and you're looking at this property and you're like, it's trash here. Oh my goodness. Look at because I always do crime areas. So I know anybody can Google, and they like, oh my God, this happened here. So I find that the presentation of the property, sometimes you have to show the business plan of what you're going to have the property look like. And then say, hey, we're taking it from here, but this is where we are going. And this is, once we acquire the building, by day 30, all this paint will be done over here. By day 45, we have this milestones. This gate is reinforced. We have new floodlights. Why do we want big floodlights? Because we don't want crime in the area. People like to do things in the dark. Mm-hmm. That's what we're doing. Oh, the signage. We're changing the signage of the building because guess what? We want to know that we're changing a different culture of the building.
Big piece. Yeah.
So you want to inform that, because if someone's going to be frightened, they're going to be like, I'm not putting my money into that.
Right.
We're visual first. The first thing we're going to have is visual. So you have to make sure that you're communicating that and showing them what it can be and then where it is right now. And then that's why I said earlier, the business plan. I like to really, I don't know if any other operator likes to do it, but I like to thoroughly express what the business plan is. Because I want my investors to know, like, hey, one, I care. And I'm put together. We're organized. That's what I want you to know. And I want repeat people. This is something that we want to do ongoing, because it only takes one wrong deal and you're done.
Right.
You're done.
You mentioned location, deal size, price per door, year built. I think I missed one right here. Class of the building.
Got class of the building, the cap rate and the cash flow.
Cash flow. Okay.
So we talked a little bit about location. So we talked about the location already and how I'm looking at the location where whether it's a landlord friendly or tenant friendly,
Mm-hmm.
and then some other metrics earlier I mentioned on location. Deal size is important as well. I like to do normally units above 70 units. My criteria is a little changing right now. I don't really want to do anything under 100 units.
Mm-hmm.
And that kind of impacts where the cash flow is going. Price per door, I'm looking at that. I have a deal that we have in the works right now that's in Lubbock. The Lubbock property that we bought in November, we bought at $67,000 a door. This is 92 units. I have a 101 unit that we're looking to buy at $42,000 a door. It's an old mom and pop guy that had it for almost 29 years.
So that's the acquisition price per door.
Yeah, per door. And so I look at that as a metric, like, oh man, that's solid. I look at the year built. I like to do after 74. I preferably like over 74.
The lead stuff.
There you go. Yep. Also, there's a least likely chance to have aluminum wiring. So a lot of those older buildings have aluminum wiring, and when you have that, you're not gonna. You have to account that your insurance company is not going to get it, and you're going to have to change those over. I'm also looking at the breakers. Most insurance companies won't insure when you have Federal Pacific breakers in there. So you want to see what type of breakers they have in there. So those are kind of the things that I like for that year.
So we've got about maybe 45 minutes into the conference. I feel like we could do 3 or 4 more of these, just talking just an abundance of knowledge through the experience, Noel. Yeah. It is awesome. Is there anything like spreadsheet wise or a list of criteria? Or is there anything that we could share with the listeners? Because there's so many people listening to this podcast that are the LPs.
I'll definitely send over. I wish I can go into the napkin underwriting, because you'll get a lot of deals. You have to know how to evaluate them fast. So I have a napkin underwriting exercise too that I can provide. But yeah, I can give some spreadsheets on just underwriting, and if anybody has any questions, maybe we can come back on and just talk about underwriting one day.
Yeah.
I can give the underwriting. I can give you target acquisition criteria, what we're looking for that. I can give you a checklist for property management and a due diligence checklist. These are things that you can definitely utilize. Yep.
That would be huge. It'd be huge. And we'll definitely book another show and get you on here. This has been absolutely amazing.
I touch on everything that I really wanted to.
Man, come on. We could just be hours and hours and hours of this stuff. So we've got...
Oh, man. The best part about apartment building is the forced depreciation. And I'm just going to leave you at this. If I have a 100-unit building, and let's just say out of that 100-unit building, 35 people have dogs. I can say, guess what? You have a pet or a cat or whatever. Somebody had a python. Guess what? Now you have a pet fee. Take out your calculators, everyone, because I'm doing it right now. We'll do 50 times 35 equals 1750. We'll times that times 12. That's 21,000. You divide that by the cap rate. The cap rate normally follows interest rates, but each area you should ask whatever broker that's in that area. I know for this area, it's about a 7% cap rate. I'll divide that by 0.07. I didn't increase the value of the building by $300,000
for some dogs and snakes
that was already there. That's where I started. And you can do that. One of the things I like to do also is with designated parking. You have designated parking when you take over a building, and every property manager I always have, because you always have to vet your property managers as well when you bring a new one on and give them their business plan and let them know how they want to execute. But everyone will be like, well, they're already there. I don't know if they don't want the designated parking. They've been having it. And I always say, this is what you do. You tell them right now, this is how much the designated parking is. You tell them this is where we're going for the area. You give them that designated parking in front of their building free for 2 months. New people, you give it free for them for 3 months. I guarantee, I have metrics, almost 98% of the people, when you say, yes, what, you have to take that away now, they're like, oh no, I got used to parking in front of my.
Give them the ownership. Let them touch it. Yeah. Interesting. Yep. So I was taught this was as air equity and priming the pump. So in the same way where we're creating this value out of midair, that's why the dollar bill is fascinating to me. The value, what value is there? But this idea of we're creating this value and priming the pump. So that's a less money.
The magic formula, because we didn't even touch on rents. So say if you had a 200 unit building, and you increase rents $25, and you are at a 5 cap. Everybody listened that I did before. You can do the math, but $25 rent you're increasing for a 200 unit building at a 5% cap rate. That creates $1.2 million value, and all you did was $25.
Yep. It's awesome.
That is the magic formula for appreciation. That's why I love apartment buildings. You mentioned earlier I did distressed properties where I made art, and they were like, man, I could use some pictures.
Yeah.
But wait until you were getting paid. Now, if you already have a cash flowing asset, you're already getting paid immediately day one, and you're bringing up units as you go along per your business plan.
Awesome. Cash flow day one and forced appreciation, the little cherry on top. Noel, man, create wealth without Wall Street with a little asterisk by there, because there's never, ever the right single answer, right?
Ever.
So just trusting in yourself and being able to create this network. And I'm sure everybody's heard this before. Your net worth is your network. Being able to have those the relationships allow you to learn as you can, and what to focus on, what's the important pieces. And Noel, you are just laying it down here for the apartment building stuff. How can the listeners get a hold of you if they were interested? I know you're not raising capital right now. If they were interested, would you want them to reach out to you on Instagram or email? What do you think?
Both Instagram and email. You mentioned it earlier. I am revamping my Instagram page, but it is at christiansexsymbol.com.
There it is.
Don't forget the Christian sex symbol. Yeah. And then also my email is at noel@crowncapitalcorp.com. Awesome. I'm always, I definitely want to send you over the document. So please hand that out. And listen, I'm an open book. I believe in abundance. So I'm always here to tell you questions, things that I'm seeing now in, markets, DSCRs are like, the banks sometimes are wanting them to be like 1.40 sometimes.
Oh,
That was a really high one that I heard on the high end, but things are changing a little bit with the loan of values. Normally it used to be like 20 to 25% that you could put down on a building. Now they want 65, sometimes 55% loan of value. So you're bringing 35, 40% down payment to properties. So certain things are changing within this, but that's another conversation.
It's all an equation. You got to put the right numbers in for sure. It's math. It's math, baby. So we've got a ways of getting a hold of you. I hope you guys have enjoyed this very extended version here today, but still abbreviated with this man's experience and knowledge. So you reach out to us, info@physicianwealthsystems.com. You can grab these resources. I'm definitely going to hit Noel up for these resources. We'll get them posted on the website as well, too. So thank you, everybody, for listening today. Stay tuned. Send us some comments on some more additional questions for Noel. If you're thinking about doing syndications, if you know a GP, if you know of any of this stuff, reach out, ask the questions. We can put some stuff together so we'll be ready for Noel next time. And Noel, man, thank you. Wow.
Thank you for having me. I appreciate it, Brett.
I'm excited to do this again, all the way from Philly, everybody. Noel Parnell. And thank you, everybody, for giving us a listen today. We'll catch you on the next one.